Most people think Europe is a high-tax fortress. In reality, there are pockets, some inside the European Union, where internationally mobile people can, under the right conditions, lower their tax bill dramatically and sometimes pay nothing on certain kinds of income. Today we'll walk through how the non-dom idea works, what remittance basis actually means in practice, why Cyprus is so popular with investors, how Spain's so-called Beckham Law functions, and where people get into trouble with things like permanent establishment and residency certificates. This is a map of the terrain, not legal advice. If any of it seems relevant to you, confirm details with a qualified advisor, because rules and interpretations change. Two ideas that unlock the whole topic. The first idea is non-domiciled or non-dom status. In a few European countries, you can be tax resident without automatically being taxed on your entire worldwide income. The second idea is the remittance basis. Under a remittance basis, you are not taxed on foreign income and gains unless and until you bring that money into the country. In everyday life, that means money you wire into your local account to cover living costs can be taxable, while money you keep abroad, spend while traveling, or reinvest outside the country may sit outside the local tax net. The mechanics and anti-avoidance rules vary by country, but that's the core concept. Malta and Ireland, the classic EU non-dom routes. Malta is a textbook example of the remittance basis. If you are non-dom there, foreign source income that you do not remit to Malta can be outside Maltese tax. The moment you bring funds in to pay rent, groceries, or other living expenses, local tax can apply. Some Maltese residency routes come with program fees or minimum tax and a set of conditions. The figures and criteria depend on the route and can change with policy. A detail many overlook is the difference between living there under the rules and actually obtaining a formal tax residency certificate. Malta will typically expect a meaningful physical presence, commonly around 6 months in a year, before issuing that certificate. Without it, you may still file returns and pay what's due, but your paperwork for banks or treaty claims can be harder. Ireland is also a long-standing non-dom jurisdiction. As a non-dom, you are taxed on Irish source income, and foreign income and gains are generally only taxed to the extent you remit them to Ireland. Administratively, Ireland usually expects you to file a full return declaring worldwide income and then apply the remittance rules inside the return. That's a little more involved than Malta's approach, where you primarily report what you've actually brought into the country. It's worth noting that the United Kingdom historically ran one of the most famous non-dom systems in Europe. The framework has been moving towards shorter tax-free windows on foreign income for new arrivals. Anyone considering the UK should check the current rules rather than relying on what was true a few years ago. Cyprus: dividends, interest, capital gains, and a fast certificate. Cyprus takes a different tack. The corporate tax rate is 12.5%. For individuals who qualify as non-dom under Cyprus rules, dividends and interest are typically exempt from local tax, and many capital gains are treated favorably. That simple fact explains why so many people structure their affairs so that profits are first earned in a company and then paid out as dividends to the individual. If you are properly resident and non-dom in Cyprus, those dividends can arrive with no Cyprus tax. Another practical attraction is the possibility of a tax residency certificate relatively quickly. Under the 60-day rule, if you satisfy the conditions, such as having a permanent home in Cyprus, not being tax resident elsewhere during the year, and spending the required time in the country, you may obtain a certificate after roughly 2 months. For people buying property, applying for mortgages, or relying on tax treaties, that piece of paper matters. Where things often go wrong is in confusing categories of income and in ignoring substance. If you, as a Cyprus resident, simply run a US LLC from your apartment in Limassol and treat all the income as if it were passive, you are likely to be disappointed. Cyprus treats a US LLC as transparent in many cases, which means active business profits flowing to you can be taxed as personal income at progressive rates up to 35%, plus social contributions. The usual solution is to insert a foreign company that is recognized as a corporation, not transparent, so that the money reaching you is a dividend. For a qualifying non-dom individual in Cyprus, that dividend can be exempt locally. All of this only makes sense, though, if the company you claim is managed abroad actually has real management and control abroad. That means genuine directors, decision-making, and records where you say they are, not just a post office box. US LLCs, Malta, and the permanent establishment trap. Living in Malta full-time while running a foreign company from your kitchen table invites a different problem: permanent establishment and management and control arguments. In plain English, if you actually run the business from Malta, Maltese authorities can claim the business has a local taxable presence, regardless of the flag on the company papers. Some advisory firms respond to this risk with multi-company Malta stacks, an operating company, a distribution company making use of Malta's refund system, and a foreign holding company to push profit out as foreign income. The approach can work, but it's expensive and heavy on administration. Many entrepreneurs prefer to build real substance in the jurisdiction they claim and keep structures simple, rather than paying for 3 sets of books just to suit one country's refund mechanics. Monaco and Northern Cyprus at a glance. Outside the EU tax design conversation, Monaco remains the purest illustration of zero personal income tax for individuals, with some French resident exceptions. Residency requires means, accommodation, and presence. You don't have to be a billionaire, but you do need meaningful funds and a stable setup. Northern Cyprus, which sits outside the EU and has a disputed international status, is sometimes used because of its light-touch environment for foreign source income. Banking, recognition, and practicalities can be more complex there, so anyone considering it should think beyond the headline rate. Spain's Beckham Law, and a useful calendar nuance. Spain offers a special expat regime often nicknamed the Beckham Law. The modern version targets people who move to Spain to work or to start a qualifying business and who meet the current eligibility rules. Typically, Spanish source salary is taxed at a flat reduced rate, commonly 24% up to a threshold, and foreign source income can receive favorable treatment for up to 6 years, depending on the category. Spain also illustrates how residency tests differ. Spain uses a calendar year day count. With careful timing, someone could arrive in July, stay through New Year, then remain until the end of June, and still be under 183 days in each calendar year. That is a timing nuance rather than a loophole, and it must be considered alongside other ties, like where your family lives, where you own a home, and where you manage your business, because those can still tip the balance toward residency. The 6-month rule isn't universal. People love to repeat 183 days as if it were a global law. It isn't. Germany, for example, often looks back over a rolling 12 months. Spain looks at the calendar year. Many countries also consider your center of vital interests, your habitual abode, your main home, your family, and where your economic life is managed. You can be under 183 days and still be resident if the rest of your facts point to that country. Owning a home versus becoming resident. In German-speaking countries, having a permanently available home can create unlimited tax liability even if you're under 183 days. In Southern Europe, the picture is softer. In Spain, Italy, Greece, Cyprus, and Malta, simply owning a home does not automatically make you tax resident. Authorities look at day counts and ties. Elsewhere, Portugal or Croatia, for example, you may need to show that the property is a true holiday home or leased out while you are away to avoid assumptions. Even outside Europe, the general idea holds. You can often own a holiday home in the United States and spend several months there without becoming tax resident, so long as you stay under the substantial presence thresholds and don't create other binding ties. Perpetual travelers versus choosing a base. It is possible to live as a true nomad, rotating between 2 or 3 countries and never triggering residence anywhere. That can work when you genuinely have no fixed base and you keep day counts low. But if you expect to spend many months in your home country each year, it can be safer and simpler to establish a clear tax residence elsewhere that issues a tax residency certificate and has a tax treaty with your home country. In disputes, consistent facts and a certificate carry weight. Is zero personal income tax realistic in Europe? A blanket zero on all personal income is rare. Monaco is the obvious case. What is common are low or zero rates on specific categories for a limited period, or permanently for certain types of income. Malta and Ireland rely on the remittance basis, so foreign income you don't bring in can sit outside the net. Cyprus is attractive because dividends and interest are often exempt for non-dom individuals, and capital gains can be treated favorably. Spain's expat regime can reduce local tax and protect foreign income for up to 6 years if you qualify. Italy and Greece have adopted lump sum programs where new residents pay a fixed annual amount and exclude foreign income from local tax. The numbers and conditions are policy tools and can be revised. The thread running through all of these is simple. Governments want to attract internationally mobile talent and capital, so they design narrow, rule-bound doors rather than wide-open tax holidays. 3 mistakes that cause the most pain. The first mistake is ignoring substance. If you claim your company is managed abroad, but you actually run it from your laptop at home, you invite permanent establishment and management and control assessments. The second is worshipping the 183-day myth. Many countries rely on more than days, and residency can still attach when your life is clearly centered there. The third is misclassifying income. In Cyprus, the advantage largely sits with dividends and interest for non-DOMs. If you accidentally turn that into active income by the way you operate, you can lose the benefit entirely. Europe isn't one tax system, it's dozens. The opportunity lies in matching your real life to a country's actual rules. Do you need a residency certificate quickly for banking and treaties? Do you earn active business income or mostly dividends and interest? Will you truly live somewhere 6 months a year, or are you a genuine nomad? Used thoughtfully, non-dom status, remittance-basis taxation, dividend exemptions, lump sum regimes, and expat frameworks can reduce tax on certain income to very low levels within the law. Used carelessly, the same ideas can produce double taxation, residency disputes, and expensive audits. Take the map, study your route, and get your facts aligned before you move.